Paul Craig Roberts is on the show. Now, Paul is the chairman of the Institute for Political Economy. Let's try that again. He's the chairman for the Institute of Political Economy and served as the Assistant Secretary of the Treasury in the Reagan administration. Let's start off, okay, Paul, by talking about Greece. Now, has the Eurozone's approach to the Greek economic and debt crisis failed? What are your thoughts?
Yes, it has. And either the EU's approach will have to change, or we may see Greece exit the system. You know, I was intrigued by the report that the Russian government had offered financing to Greece. So if I was the Greek finance minister, prime minister, I'd be tempted just to default on the debt and line up with Russia. Because you would then be, if you defaulted, you would be debt-free. You'd have a perfect credit rating, and therefore you could borrow from the Russians. And that would begin, I think, the unwinding of the EU, because Italy would follow, Spain would follow. So Russia has a chance to unwind the EU.
You know, that's interesting that you bring that up, and I'm glad that you do. I want to ask you, how realistic is that scenario? And if it does happen, is Russia really in a position to be handing out money to countries defaulting on their debt right now?
Oh, sure, sure. And if they aren't, their strategic partner, China, is. And the BRIC Bank, you know, they've set up this BRIC Bank, allegedly has $100 billion. So I do think if the BRICS wanted to reduce the pressure on them from the United States and the American puppet states in Europe, they could do that. It would be a brilliant stroke to acquire Greece, because I think, as I said, Italy and Spain would follow. And of course, the EU is under other pressure because of the very hostile American moves against Russia. This now worries Germany and France. They see they're being pushed into a confrontation that doesn't benefit them, that they don't want. So you really have the EU under two pressures. One, the refusal to make any reasonable deal with the indebted countries. And second, they are pressed by Washington into hostile actions against Russia that's against their interest. So the whole system is under tremendous pressure right now.
Paul, the Greek finance minister, Yanis Varoufakis, wrote an op-ed in the New York Times on Monday in which he wrote, quote, "Our government is not asking our partners for a way out of repaying our debts. We are asking for a few months of financial stability that will allow us to embark upon the task of reforms that the broad Greek population can own and support, so we can bring back growth and end our inability to pay our dues." Now, that sounds well and good, but the economic group formerly known as the Troika is saying to Greece, either follow the existing program or suffer dire consequences. So it doesn't look good, does it? What do you think is going to happen, realistically?
Well, I think if the EU is sensible, it will back off and write off some of the debt. You know, what we have learned from the Greek case, we've actually known since from the 1930s, from John Maynard Keynes, that when you impose austerity on a country, you drive the economy down and it's less able to deal with its debt. And that's what's happened to Greece. The austerity program has driven the economy down such that the burden of the debt is now a much greater one than it was prior to the austerity. And so the Greek finance minister is recognizing that and says the only way we can possibly service these debts is to have a growing economy. And yet the program you've put on us is driving the economy down, and therefore the debt burden becomes larger year by year, and we can't deal with it. It's driving the people into the ground. And so something has to be done. So I'm convinced that the Greek government, this new Greek government, will have to stand its ground. Now, of course, we don't know what kind of threats it's receiving from Germany and from Washington. I mean, these threats could be horrific. But on the whole, it looks like a determined government. It got a mandate, and it has to stand by it. And so it will be up to the Germans whether or not they force this to a conclusion that Greece leaves the euro and the EU. that would be a terrible mistake if you want to hold the EU together. Because if Greece leaves and they are picked up by Russia or the BRICS, then you can see Italy and Spain starting to make the same kinds of negotiations. So this controversy and the failure of the EU to realize what's really at stake, it's not just the creditors of Greece, it's the EU itself. This could end up splitting up the European Union.
Paul, if you were negotiating for the Greek government right now, what would you do?
Well, I'm much more radical than they are. I would call up Putin and say, is that loan offer real? And if he said yes, then I would call up the creditors and say, we default, we're not paying a cent.
There you go. You'd see if that offer was still on the table. And then go
reopen the central bank and start issuing Greek currency.
There you go, and toast to it in Santorini or something. Now, Paul, while stocks in the U.S. have done reasonably well, oil and commodity prices have plummeted, and so have the yields on the safest global government bonds. So what's the connection here between capital allocation debt and stock market volatility?
Look, the real funny thing is that the world is sinking into depression, and that explains the collapse in commodity prices. The demand is gone, and yet the stock market in New York is very high. So clearly the stock market either hasn't a clue about the real economy or it's rigged. It has to be one or the other. You can't have the worldwide collapse of commodity prices, which is always a sign that demand has collapsed, which is a sign of serious recession, depression, and yet the stock market right now is over 18,000, the Dow Jones in New York. So either the market is not a predictor of anything, that it hasn't a clue, or the stock market is totally rigged. There's no other alternative explanation.